In this video, I'm going to teach you about velocity banking, how to implement it, and exactly how the math works. Now, before we go any further, we have to understand how the interest calculates on both your mortgage and your HELOC. So for your mortgage, the monthly interest is calculated by using the principal balance times your 6% APR, which is 0.06 in decimal form, divided by 12. Now the payment that goes towards your principal is your monthly payment minus your monthly interest that we calculated in the previous step. Now your HELOC is a simple interest loan. And to figure out how that calculates, we have to figure out the daily rate because you get charged a daily rate on the daily balance of your principal. So to figure out the daily rate, you have to get your APR divided by 365 days per year, divided by 100 to turn it into a decimal form. And that equals your daily rate. Now daily interest is equal to your daily balance multiplied by your daily rate. And that's the amount that you're going to get charged for the principal balance on that day. Now to calculate your monthly interest, all you have to do is sum up all the daily interest charges that you've accrued throughout the duration of the month. Next, we're going to dive into the loan details. And this is an amortization calculator from mortgagecalculator.org. So if we look down here, I applied a principal of $400,000 at 6% for 30 years. This equals a total monthly payment of $2,398.20. I also started the loan date on December 1st, 2023. So down here is your amortization schedule, and this is how much interest and principal will be applied after every payment is made. So the idea of using a HELOC is pulling out $15,000 from your HELOC, transferring it to your checking account, and dropping a lump sum on the principal balance. Now keep in mind, you still have to pay your mortgage payment like you usually do through a checking account. So if we bypass all of this interest here until our principal balance gets to $15,000 less, which turns out to be in payment number 34. So that's where our principal balance is now $385,282.32. So the minute that you drop $15,000 on your principal, you bypass all this interest above. And all this interest above adds up to $19,391.31 just by dropping $15,000 on the principal on your first payment. Now let's break this payment structure down. Let's say you get paid $8,000 per month take-home pay. Your mortgage payment, like we said, is $2,398.20. So we're going to round that up to $2,400. And remember, this is paid like you normally pay it through a checking account. Now the payment that you're going to apply to the HELOC is $5,600. And this is your paycheck minus the $2,400 that you're going to pay to continue paying your normal mortgage through a checking account. The leftover balance is $5,600. All that is going to be the payment to your HELOC. Now your monthly bills, we're going to say that they add up to $4,000. Now let's take a look at what this breaks down to. All right, so let's break it down. So you have a HELOC, let's say for $20,000 to $30,000. You pull out $15,000 and transfer it to your checking account, and then you drop that $15,000 on your principal balance. Well, now you got to repay this HELOC, right? Now remember, the minute that you drop that $15,000 on your principal, you instantly bypassed 2 years and 10 months in this example of interest, saving you $19,391.31 just by making that $15,000 lump payment on your principal only. Now let's take a look at the repayment structure of your HELOC. So I calculated this for extreme purposes at 28%. Now, HELOCs currently are around 12, 13%, and the maximum they could ever be is 18% because they are a variable simple interest loan. So here we have our loan details. I input $15,000 at 28%, and this is to go extreme, right? Because we know a HELOC can't even go up to 28%. But let's say, for sake of argument, we're going to use 28%. Now this chart here shows the annual interest that you would pay if you paid interest only. So that's your $15,000 balance. Your daily interest would be $11.51. And for month one, you would pay $345.21. Now this continues to compound for a total interest of $4,709.18. Now this spreadsheet does include all the other decimals, so it will be slightly different by a couple dollars on the breakdown sheet. So even if we paid $4,700, and if you subtract what you saved by dropping that lump sum on your principal of your mortgage, that $4,680 that you paid in interest minus the $19,391 that you originally saved on your principal, you're still saving $14,711.31 on the interest of your home. So this is the repayment structure of the HELOC. Let's say the first 1 through 10 days, we left the balance at $15,000. So our daily balance remains $15,000, and we would be paying $11.51 each day. Now you get paid, and that HELOC payment we add here on day 11 of $5,600, which brings our daily balance to $9,400. Now for these next 5 days, we're going to be paying $721 a day for interest. And then let's say all of our bills go through in one day, which they won't, they're going to be spread out throughout the month. Let's say they all go through, for sake of argument, on the 16th. So there we're adding $4,000, and our new balance, daily balance, is $13,400. From here, from the 16th all the way to the end of the month, which I have calculated to 30 days, we'll be paying $10.28 a day. Now the monthly interest on month one is $305. And if you could see throughout the course of this spreadsheet here, we continue to apply the same payment towards the HELOC of $5,600, and we continue to apply the bills of $4,000 every month, month 2 and month 3, and so on. And when we get to month 8, we have paid off this HELOC in full. Now we still have to calculate this daily interest for days 1 through 10. So next month we would owe the interest of these amounts, and we would pay that off in full on month 9. So we would have paid a total of $1,523.44 and paid the HELOC off in full in 8 months. Now let's go over the interest savings. The interest savings on the mortgage was $19,391.31. That's when we initially dropped that $15,000 on the principal. Now let's look at the numbers if we only paid interest only on the HELOC, which as we covered you should not do. You would have paid $4,680 of interest on that HELOC, keeping the principal balance at $15,000 for the entire year. That still saves you $14,711.31 of interest on your mortgage, which is this $19,391 minus the interest paid on this HELOC of $4,680. Now the interest paid on the HELOC, if we follow the schedule that was planned out by depositing the remainder of our paycheck to the HELOC and also take into account our monthly bills being paid through the HELOC, the interest paid would be $1,523.44. And you would have saved on your mortgage $17,867.87.